What's up, guys? This is Vinay and welcome to Set Up to Win, where we help get your life to that next level. When trying to buy a house, most people opt to use a mortgage to help with the purchase. And with mortgages, the two most popular options are the 15-year mortgage and the 30-year mortgage. Some people tell you to get a 15-year mortgage, while others tell you to get a 30-year mortgage. Who's right? Let's find out. When you're trying to decide which option is better, the 15-year mortgage or the 30-year mortgage, you need to take a step back and ask yourself, what are my goals with this house? Let's look at what some of your goals might be. Is it your goal to pay off the house as quickly as possible? Or are you just trying to get as low an interest rate as possible? Or you might want to consider, how long do you want to stay in this house? Is it only 5 or 10 years? Or do you just plan on using this mortgage as a stopgap measure only to refinance out later when mortgage rates drop? I know a bunch of people who want to pay off their house as quickly as possible. It's a goal of theirs to own their home free and clear. And trust me, I get it. When your house is paid off, you have a great sense of accomplishment. Your stress levels are probably lower, and the income required to maintain your lifestyle is smaller, and the money that would otherwise go towards a mortgage payment can now go towards other things, maybe investments, starting a business, or even fun things like your dream car or a fancy vacation. And many of these people opt for a 15-year mortgage because they feel like this will help them pay their house off faster. As you can probably imagine though, using a 15-year mortgage versus a 30-year mortgage will result in a much higher payment. How much higher? We'll get into an example in a minute here. On the other hand, many other people will tell you to opt for a 30-year mortgage. As we just said, the monthly payments will be a lot lower than a 15-year mortgage, and you'll have more money to spend or invest elsewhere. And because the monthly payment is lower, the bank will probably approve you to buy a more expensive house. Or sometimes people purchase a house with the idea that they're only going to own it for 5 to 10 years before they sell it. In this case, it might not be a goal of theirs to pay the house off. It might be their goal to own the home and make as low a monthly payment as possible. Everyone's situation is different, and this is why they call it personal finance. It's personal to you. This is not a one-size-fits-all business. Before jumping into an example, you should understand that a mortgage payment is oftentimes broken into 4 components. You can use the mnemonic PITI, which stands for principal, interest, tax, and insurance. Tax and insurance are going to be the same no matter if you have a 15-year mortgage or a 30-year mortgage. For that matter, tax and insurance will be the same even if you paid for the house in cash. Since these two things are constants, no matter how you pay for the house, let's leave them out of our discussion. Here's an example to shed some light on the differences. Let's say you want to buy a $300,000 house and you put 20% down. So that means you pay $60,000 as a down payment. So you finance the remaining $240,000 through a mortgage. 15-year mortgages are less risk for the bank. There is a lot less that can go wrong in 15 years versus 30 years. Because it's less risk to the bank usually offers a lower interest rate compared to 30-year mortgages. This is usually 0.25% to a full percent lower than the 30-year mortgages. For example, let's say the current rate you get is 2.25%. Your monthly payment, which again only includes principal and interest, would be $1,572. If you kept this mortgage for 15 years, you will obviously have paid off your house after 15 years. You will have paid a total of $282,997, which breaks down to $240,000 in principal and $42,997 in interest. Alternatively, let's say you finance the $240,000 through a 30-year mortgage. Your monthly principal and interest payment would be about $1,012. After 30 years, you will have paid off the house, and paid a total of $364,266, which breaks down to $240,000 in principal and $124,266 in interest. When comparing these side by side, a few things pop out. Number one, the 15-year monthly payment is much higher than the 30-year, more than 55% actually. And number two, you pay so much more interest with the 30-year versus the 15-year, nearly 3 times as much. But before jumping to quick conclusions, this is kind of an apples to oranges comparison. To make it more of an equivalent comparison, let's compare the 15-year mortgage to a 30-year mortgage where you make extra monthly principal payments so that the house is paid off in 15 years. So the 15-year numbers will remain the same. Now, let's say you take that same 30-year mortgage with the 3% interest rate. On top of your $1,012 monthly payment, you decide to pay an extra $650 per month. When you make these extra payments, this extra $650 goes directly towards paying down the principal. By making this extra $650 monthly payment, your house will be paid off in 15 years. So your total principal and interest payment would be the $1,012 monthly payment plus the $650 extra payment for a total of $1,662. Over the course of 15 years, you will have paid a total of $298,122, which breaks down to $240,000 in principal and $58,122 in interest. Again, at first glance, it looks like the 15-year mortgage is better because you are paying $15,000 less in interest, which works out to an average of about $1,000 less interest paid per year. While this is true, you need to consider that with the 30-year mortgage, you have the option not to make that $650 payment. You can scale back your payment and not be as stressed. And one thing to know is that suppose you've been making your mortgage payments for 14 years, you get to that 15th year and you lose your job and you can't make any payments for a few months. The bank doesn't care. They will foreclose on your house and they'll take that house from you. It doesn't matter that you were diligent for those 14 years. The bank is a business. It is not your friend. Just something to keep in mind. To quickly recap, here are some pros and cons of a 15-year mortgage versus a 30-year mortgage. With a 15-year mortgage, the pros are that you will get a lower interest rate. As stated before, it's usually between 0.25% to a full percent lower than what you'll get with 30-year rates. And with a 15-year mortgage, your principal is going to be paid down a lot faster. A con of using a 15-year mortgage is that your monthly payment is going to be a lot higher. With a 30-year mortgage, the pro is that you will have a lower monthly payment, which usually means that you can purchase a more expensive house. And some cons of having a 30-year mortgage are that it will take longer to pay off and you are going to get a higher interest rate. So again, the product you choose, whether it's a 15-year mortgage or a 30-year mortgage, really depends on the goals you have with your house. And if it's your goal to pay off your house as soon as possible, I would still say take the 30-year mortgage option and make those extra payments. If a financial emergency pops up, like the loss of a job or a medical situation, you can always scale back that extra payment. So it might cost a little bit extra, but you maintain that option of making a lower payment. And if it's your goal to get as low an interest rate as possible, opt for the 15-year mortgage. But I would urge you to not look at the interest rate alone. This is just one piece of a bigger puzzle. Take a step back, figure out your bigger picture goals, and consider how the interest rate fits into all of that. If it's your goal to keep your monthly payments as low as possible, I would say 100% opt for the 30-year mortgage. If you just plan on owning this home for 5 to 10 years, or if you're just using this mortgage to get you to the point of refinancing when rates drop, I would say keep those monthly payments low and use a 30-year mortgage. And a few final things to consider. Once you figure your goals out, go online and use one of the countless online mortgage calculators out there. Plug your own numbers in so that you can make a more informed decision on which product fits your situation best. One thing that might be surprising is that the median time a mortgage is held is only 7 years. Many people either refinance out of their current mortgage or sell their home. Very few mortgages are actually held for an entire 15 years, much less 30 years. And yes, it is a beautiful thing to have a paid off home. But you need to remember, even if you paid off your mortgage, there are still costs associated with owning a home. So make sure you consider all the factors before making a decision. Odds are that this is one of the biggest financial decisions of your life, so take your time and measure things up before taking a leap. Please comment below with any thoughts you might have around financing a house. And if you like this video, please like, share, and of course subscribe. I'll see you guys next time.